Hey guys, this is Bennett Tchaikovsky and welcome. Our next topic right over here is probably one of the most important is basically we're going to talk today about business buyout agreements. So my disclaimer and copyright notice. The information and opinions in this presentation are those of myself and not my employers or affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. Additionally, the starting and running a corporation can involve significant tax consequences. Therefore, make sure you consult a tax advisor prior to making the decision to incorporate. Note that in this series, I'll be going over a variety of matters as it relates to incorporation and how a corporation operates. You should use this video series to educate yourself on the topic rather than to take this as any sort of legal advice. Therefore, the best way to use this video series is to learn about how corporations work and then go seek out legal counsel. The presentation is copyright 2008 to 2024 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. So let's go through and talk about now. This is basically the fourth video in the series, or where we're going to talk about buy-sell agreements. So if you have more than one shareholder, this is by far going to be very, very important, or the most important document you're going to have. And I'll talk about that in a moment. And it also is going to ensure that those that are working for the corporation earn the shares. And you want to have an attorney go through and draft this for you. It's really an insurance policy. And let me just kind of talk a little bit about this. When we form a corporation, one of the advantages, and I'll just use, I was talking earlier about Daniel. So we'll have over here Daniel, and we'll also have Bennett. Okay, so Daniel, we're each going to get 100,000 shares. Okay, and we're going to start up, I don't know, we're going to start up like basically a consultancy practice, or we're going to develop a new accounting product, right? So we each have 100,000 shares when the corporation is formed, and we're going to issue those shares to ourselves at 0.0001 par value. So the amount that I'm going to have to write the corporation a check for to purchase my shares is going to be $10. And when you kind of think about this, right, this is really the advantage of being a corporation. And I talked a little bit about this earlier, but when you hear about, oh, like Jeff Bezos has this huge amount of wealth, Mark Zuckerberg has this huge amount of wealth. However, when you look at their wealth, it's really tied up in the shares of stock they own of Meta Platforms or Amazon. They haven't realized that wealth by going through and selling the shares. So, but the reason why they've been able to gain that type of wealth is because when they formed the corporation, they issued shares to themselves at par value. Now, totally legal to do. And you want to talk to your attorney about this, but this is really important. If Daniel and I start working together, everything's going good, and we say we create a business plan where we're going to achieve profit in year 4. And we decide that, okay, these shares, when do we really earn them? Well, because we're going to both be taking no amount of money, year 1, 2, 3, and 4, we're really going to be earning about 25,000 of these shares each year. Because if I stay for a year and it's going to take us to 4 years to reach profitability, I'm really not going to have earned those shares because I'm getting them to myself in advance. I'm not really going to have earned those shares until year 4. So the purpose of this buyout agreement, and I love doing this in my classes, is I basically take a share of stock and I start walking out of the room with it. And I go to my class, I'll say, what are you going to do to stop me? How are you going to stop me from running away with these shares? Because if I leave Daniel, if I leave the corporation all of a sudden, this happens a lot, by the way. If I leave Daniel behind the corporation, I still own half the company. But what could actually take away, or what could I actually use as a mechanism to keep those shares to, because I really haven't earned them yet? It's the buy sell agreement. And there's also a lot of other things that will kind of come into play. For example, Daniel's a single guy, Bennett is married. If for some reason something happens to me, death, divorce, bankruptcy, all of a sudden I'm no longer Daniel's partner. My wife is, or my estate is, or something like that. So the reason why this agreement becomes so important, and it always drives me crazy when I ask students, is that if you heard of a business buyout agreement, and they tell me no, and I'm like going, dude, this is like crazy. This is like one of the most important things you can learn. And that's really why we're having this conversation today. So this is going to be something, it's like an insurance policy. You're going to want to have somebody go through and draft for you. But again, it's very, very important to have an outside counsel draft this. If you've watched The Social Network, if this was in place, you'd never have any of those shenanigans going on. But let's take a look. So this is a template basically defined under the circumstances which it's triggered, right? So this is going to be something that's going to be entered into by the shareholders. And if you have the death of a partner, disability of a partner, retirement of a partner, bankruptcy, voluntary withdrawal, divorce, disability, yeah, all kinds of different things, that's what you're going to get into. Now, how is the value of that interest going to be determined? How do you set up the value? Again, becomes very, very important to do. It's not, if you've been establishing the business, and if it's a 0.001 par value, it's going to be worth more than $10 after a year of work, depending on what's been achieved according to the business plan. So again, when you look at this, how you determine the valuation method becomes very, very important. Purchase price, what's going to be, how you're going to basically buy it out, payment terms, lump sum, installment, financing options. If someone decides to leave a partnership immediately and you've got to pay them out, that's going to be very, very tough depending on the cash flow of the organization. If someone dies, what's the funding mechanism? Do you get a life insurance policy? Do you get disability insurance? How's that going to happen? And more importantly is, if I leave and I sell my interest to somebody that doesn't like Daniel, then Daniel's going to be absolutely miserable. And you really just want to remember that things may seem to be going really well when you're starting up a business together, right? It may seem to be going really well, and then it just all falls apart. So this is just kind of an example over here of a template, and governing law, indemnification, all the, you have to make sure you're having an attorney draft this for you. Now, over here, this is nolo.com. Nolo.com, and they're not sponsoring this video, but what nolo.com basically does is it's a lot of DIY. I made the huge mistake one time of assisting. I probably knew my friend's marriage was going to end when I gave him his wedding gift. I said, well, if you ever get divorced, I'll help you file the paperwork. And oh boy, did I pay for that wedding gift. Okay. And what was even worse is that his friend's ex-wife came literally to the courthouse fully pregnant. I had filled out some of the forms wrong. And holy, that was like that's like a dumpster fire inside of a dumpster fire inside of a train wreck. I mean, that was like terrible, right? Wow, Bennett, you gave someone, said you'd do their divorce. Yeah, I mean, crazy. Okay. But this is something over here, like this website can give you a lot of good general information about different legal topics. But if we come over here and look at their buy sell agreement, right? And if we look at this, do you need one? If I'm a single owner, right? Not going to need it. But when you have over here, it's like, what do you have? Basically, basically is a binding contract amongst the business owners. What is a buy sell? When an owner must leave? If I lose my professional license as a CPA, what happens? Triggering events, how to time the buyout, who can buy the shares out, how much is it worth, what happens after the business owner leaves, what are the types of buy sell agreements, shareholder buyout agreements. Let's see where this takes us. Basically, do you need one? Over here, basically, this is going to kind of go through and walk you through some of the different parts. The other thing I would also tell with you to do is that if you come up and if you talk with your fellow owners about these topics, which can be kind of unpleasant sometimes, um, you can save yourself a lot when you go to the attorney. Basically, what you're going to kind of go through and do is you're basically, when you go see the lawyer and you say, hey, draft this document, probably save yourself a lot of money, because at that point, the attorney is not doing all the investigation or questioning, but they're just doing the drafting. In fact, if you were to go over here and, if you bought the book on, okay, so you're going to find a lot of information here. So corporate bylaws. Let's see here. Hold on. So right over here, business buyout agreements, basically learn more. Hold off disagreements with basically what are you going to get, product details. Okay. Basically, they're going to include basically it's going to have included forms, which is basically a buy sell agreement. I have actually used this in my managerial accounting class when I'm teaching. I show my students an example of this. It's actually a pretty comprehensive document, but it's at least going to give you some things to kind of go through and think about when you're going through and doing the buy sell. My own opinion in terms of on the buy sell agreement is what I would do is I would either you can meet with your partner or your other shareholders and just say, hey, we're going to form this corporation. As a result of forming this corporation, we're going to be giving ourselves shares at a very, very low value. And we need to collectively sit here and say to each other, what is the responsibility for each one of us going forward? Like, say, going back over here, well, Bennett, you're going to do sales, content. Daniel, you're going to do back end development. And it really, when you're starting up a business with other people that you may think you know them, but trust me, you don't, because when money is involved, that's when things get really crazy. And if your business all of a sudden becomes very, very valuable, again, watch the movie The Social Network. You'll see crazy things go through and happen. But what I would do is I would have the conversation and say, okay, let's enter into a buyout agreement for, and this is basically, let's make ourselves responsible for creating the product that we're going to create. Now, I would also tell you too, as part of this, is that if you're going into business with somebody, and I said this on many different videos, you probably want to do some sort of a background check on them. And I would also offer up a credit and a background check on myself as well. I would agree to do that because I would want to make sure that whoever I am doing business with does not have any other kind of judgments. So always, and this is really what's hard about sometimes, like, because we're so intricately involved in something that we oftentimes forget that who we do business with, if you're not doing business with someone who's trustworthy, I mean, why do business? I mean, you're just going to get screwed. Again, watch The Social Network. Um, it's one of those things where the buyout agreement, I cannot tell you, I cannot overstate the importance of doing this. In my career, I've guided several different businesses. The ones that do the buyout agreement, no problems. The ones that don't do it, there's going to be a problem. And if you don't do it, it's going to get real expensive on the back end to deal with it. I promise you that much. So in any event, I would check out Nolo, and I'll include this link below. Go ahead and I would maybe look at the book or the ebook. They're not promoting this. I'm just saying it's a great one because I've actually looked at it. It's going to give you a great way to really understand, like, basically how to kind of go through and to basically go through and do this. So it's going to give you a great template that you can then go through and talk about with your partner or your other shareholders, and then take it to an attorney, say, this is what we want. The attorney is then crafting it. They're going to add their own stuff in. And then you should hopefully get a great document. Remember, if you're paying an attorney and you're going in and telling them this is what I want, and then the attorney is going to be able to basically take that information and you're going to get a much more effective document out of it. When I've worked for companies, a lot of times what I would do, because I am an attorney, but I don't practice, but I would oftentimes say, okay, I would go to the attorney and say, this is what we're looking for. I would really direct the conversation so that the attorney is not running in 20 different directions as they're hearing from different people. So that's where we are. That is the buy-sell agreement. And if you would like, thank you for watching. Please don't forget to like and subscribe. If there's any future videos you'd like to see, please feel free to send me an email to 1812cpa@gmail.com. I look forward to seeing you on future videos. Have a great day.